Taher Badshah joining us this morning, Invesco Mutual Fund. Taher, good to have you with us, especially on a morning where markets are starting to, look lower given what we've seen overnight on Wall Street, a massive fall, and our own market starting to move a little lower in terms of range around that 9600 mark, as CK had also earlier indicated this morning on technicals. Taher, is this going to be the start of a reversal, retesting of lower levels as the reality of the economic situation sets in? Is it still too early to take that call? How are you viewing markets currently?
So, given the kind of reasonably robust rally that we have seen, not just over the last 2-3 months, but more so even in the last week or so, or maybe the last couple of weeks, we've done a reasonably decent catch-up rally, which was kind of in a way expected, and probably I would have highlighted the same as well the last time around that we spoke. There is obviously a case for some bit of correction stemming out here. It is also supported by certain developments which are not really very positive at this stage, both with regard to the virus as well as with regard to some features of our domestic economy. So I think in that, as a result of that, a certain amount of correction in the market is clearly likely. I still am of the view that we're going to hold up quite well, not just the Indian markets, but even probably the global markets, given the fact that we will see the Fed being on standby all the time. We are in a situation of zero interest rates, which is likely to persist for longer than we think, and therefore it is to at least to me it appears to be a low probability even that we will go all the way back to what we saw in March. But yes, I mean, we've rallied a neat 25% odd from the lows, and therefore for us to probably shed about 5-7% can happen at any point in time. We have some of our own challenges with respect to the virus as well, which needs to unfold. It's like today it's a bit of a race between whether the virus gets ahead or whether the lockdown and the emergence out of the lockdown and the economy starts moving faster. There's a contest between both of these, which is currently on, and we'll have to probably wait and watch as to who wins the contest. So we're trying to open up the economy, but at the same time, it's fueling some of the rise in the infection rate as well. I think that's something which unfortunately we don't have a choice but to just watch it out for the next some time.
Okay. Taher, in terms of the pain in the economy, where do you really peg that at? Do you feel we're underestimating it, or do you feel we do have chances of that V-shaped recovery that everyone's talking about?
It's pretty uncertain at this stage. There is, I think we are kind of maybe marginally underestimating the impact, and there is a certain amount of, shall we say, a little bit of renewed enthusiasm which has come about as the economy has started to make attempts to open up. There are some things which are opening up quite well, but then it is more from the supply side, more from the production and manufacturing side. We still don't know. We still don't have a great handle as to where consumer sentiments, consumer demand is, and consumer confidence is. That is still relatively unknown. Today, everybody is working with a base case assumption that the third and the fourth quarters of the year of the next year of fiscal 21 will work out well. This is not just India assumption. This is more or less a global assumption as well. So I think that still looks to be on the table as of now. But we have to. It is important at the same time to make sure that things don't significantly worsen prior to that. So at least in this quarter and maybe the next, we have to make sure that things really don't go significantly downhill. If we are able to kind of come around the next two quarters, or maybe the next 3 or 4 months, I guess then we can be a little more confident about living with some of the assumptions that we have today, that we're going to probably end up with a flat growth or maybe a marginally negative growth in the system as a whole.
Taher, when I ask people why are markets going up, the immediate answer is liquidity. When I ask why markets will not fall, the immediate answer is liquidity. There has to be a reason why liquidity will move into equities, and B, if markets are only going higher because of liquidity, then what is the end game? Because liquidity will remain low for a long time, liquidity will remain high for a long time, interest rates will remain low for a long time. So are we in for like a rise and higher levels for equities in general?
In general, yes, at some level, we will probably see valuations kind of not correcting to the levels which are congruent to the kind of economic damage which is happening, and simply because of the fact that, we are, as you rightly said, and as we agreed that, interest rates are going to remain lower for longer. And if money is available at 0% or thereabouts, one can argue for technically, one can even theoretically argue for 50p multiple and even more, from an equity standpoint. So I think if markets are currently hovering around 20 odd times, with a not so fancy expectation, maybe slightly enthusiastic at, let's say, 0 or slightly negative growth for FY21, but it's not substantially at a high, or it is not at valuations which are so extended that it is difficult to imagine short rallies of 5-10% once in a while. So I would think at some level, you're right in saying that liquidity supports lower levels, but at higher levels, I think beyond a particular point, near-term valuations at least do come into play. We may have the longer picture where overall equity valuations may remain high because of lower interest rates. But suddenly when when Indian markets were to probably rally from 20 or to maybe 22, 23x with no visibility of earnings, it does make it a little difficult, to think short to medium term. I mean, as you keep rising, the air clearly starts getting a little thinner. You're a little more comfortable if you're dealing with multiples which are below 20x on an average. But when you're kind of going to the other side, you find it a little difficult to then place a lot of confidence. So that's why I say that we don't have a choice but to stay bound within a certain range for a reasonable length of time. We will probably hover and oscillate between this 9,500 and 10,500 range until we kind of see evidence to the contrary on either side.
Right, in moments from now, Ravi Dharmeshi will also join us, so I'll just connect with him. Is he ready? Okay, he's not ready. But look at the plunge in the Nifty now. About 350 points is what the Nifty has taken a knock. It is clearly an indication of how severe the cut is. So between yesterday and today, it looks like it's a completely different world. Same time yesterday, while we were navigating very nicely, all dips were bought into it, but today there seems to be intense selling which seems to be coming at least in some of the large cap stocks. So Taher, what have you added in your portfolio post the crisis? Have you changed the orientation of the portfolio?
Well, not at least much since the last time that we spoke a couple of weeks ago. It's been very muted activity at our end, and I think there's just nothing in this market immediately to conclude one way or the other. I think zero activity or low activity is the best way to go in the current situation. So we've kind of more or less stayed to the theme. Whatever we might have done even at the margin in terms of a couple of new additions or a couple of subtractions are all and may have emanated out of some of what we would have seen in the current result season. And sticking to the overarching theme that, look, wherever we found that growth is trying to be achieved at the cost of the balance sheet or by consuming any part of the balance sheet, then that is something that kind of concerns us, and we remain alert on that ground. And if we've at all done any kind of changes to the portfolio, to any sectors or to any stocks, it is mainly a function of that. There have been very few cases where probably we have found things which are really beaten down or cheap or ignored by the market, and we would have liked to take advantage of them. It's not zero, but very, very few to call out as such. So I think right now it is best to kind of stay with the current portfolio configuration. We don't really see any great merit in moving or jostling around a lot. If we get some very significant incoming evidence which dictates any reshuffle in the portfolio, we will probably do that. But right now, there's nothing at all to suggest. We've seen economic activity collapse and then starting to recover, which is a logical outcome at one level, which was in a way expected. So since we didn't really do much at the time when things were going down and the economy was struggling and was under lockdown, we don't really see the need to do anything significant when things are normalizing. So we've just stayed our course throughout most of the last 3-4 months.
Okay. All right, Taher, appreciate your time. Stay safe and thank you for joining us.